Central banks and regulators keep repeating the same warning in recent years. Global financial risks are rising, even while many asset prices sit near records. That is not a normal late-cycle message. It is the kind of signal that has appeared before almost every major economic crash of the last century. The pattern is old, the plumbing is new. The logic is the same. The system looks strongest right before its weakest links snap. Look at what always comes first. Long before headlines mention crisis, a financial cycle stretches too far. Credit grows faster than incomes. Asset prices run ahead of the cash flow that is supposed to support them. Risk quietly migrates from tightly regulated banks into the shadows. The result is a structure that looks solid from the outside, but sits on borrowed time. Check the difference between a simple recession and a true financial crisis. A normal recession can arrive without any major accident in the financial system. Inventories build, demand slows, central banks raise rates too far, growth stalls. Painful but contained. A financial crisis is different. It starts inside balance sheets. Households, companies, and banks have taken on so much debt that even a modest shock turns into a chain reaction. Think of it as the difference between a cold and organ failure. Both hurt. Only one threatens the whole body. The mechanism that leads to crisis does not begin with panic. It begins with optimism. Good times convince lenders that defaults will stay low. Banks ease standards. Investors accept more risk for a little more yield. Households and firms learn that credit is easy and cheap. Picture a party where the punch bowl never seems to empty. As long as money keeps flowing, no one thinks about the exits. Follow the money, and the same three-step pattern appears again and again. First, a boom in credit and asset prices. Second, a layer of leverage on top of that boom. People borrowing not just to spend, but to speculate. Third, a trigger that flips optimism into forced selling. The asset can change. Railroads in the 19th century, stocks in the 1920s, internet companies in the late 1990s, housing before the global financial crisis, trendy themes today. The pattern does not. History shows this clearly in the Roaring Twenties. Over several years, stock prices more than doubled. Investors could buy shares with a small down payment and borrow the rest on margin. Banks recycled deposits into loans to dealers, tying the banking system directly to stock speculation. When confidence cracked in late 1929, selling overwhelmed buying. Prices fell far enough to wipe out the thin equity that was backing huge leveraged positions. Margin calls forced liquidation. Banks that had lent against inflated collateral were suddenly staring at losses. The crash was the visible shock. The fragile debt structure underneath turned it into the Great Depression. Notice the contrast with the dot-com bust. From the mid-1990s to early 2000, technology stocks soared. Many companies had almost no profits, yet their valuations exploded. When the story cracked, the bubble burst, and the Nasdaq index lost most of its value. It was brutal for investors. But it did not fully cripple the banking system. Why? Because the leverage was lower in household mortgages and core banks. Painful equity losses did not translate into a complete freeze of credit. The boom ended in recession, not total financial collapse. Now compare that with the housing boom before the global financial crisis. Home prices rose far faster than incomes. Lenders extended loans to borrowers with weak documentation. Mortgages were sliced into complex securities and sold around the world. Banks and investors funded these holdings with short-term borrowing, assuming that markets would always roll the debt. When mortgage delinquencies started to climb, confidence vanished. Suddenly, the same securities that had been treated as safe collateral could not be funded. A downturn in one asset class became a worldwide banking panic. The added ingredient was leverage layered on top of already inflated prices. The math behind these collapses is simple. When an institution borrows most of its assets, even a small fall in value can wipe out its equity. Leverage multiplies both gains and losses. In calm periods, this looks efficient. In stress, it is lethal. The entire system becomes dependent on one assumption. That old debt can always be refinanced with new debt. That rollover process is the quiet heartbeat of modern finance. When it skips, everything else feels it. So what always shows up before an economic crash? three big forces: rapid credit growth that outpaces income, heavy leverage in key parts of the financial system, and a growing dependence on short-term funding that must be rolled over again and again. As long as confidence holds, those forces remain invisible. When something breaks that confidence, the same forces drive a sudden downward spiral. Watch the classic early warning signal: the yield curve. The yield curve, which maps interest rates across different maturities, usually slopes upward because investors demand more return for locking up money for longer. Before many modern recessions, this curve inverts. Short-term rates rise above long-term rates. That inverted curve has preceded most economic downturns in the United States. It is not magic. It simply shows that markets expect future growth and inflation to be weaker than current conditions, even as central banks keep policy tight. In past cycles, a deeply inverted curve has been a strong sign that credit conditions will tighten and that weaker borrowers will struggle to roll their debts. Check the second recurring signal: composite leading indicators. Indexes that blend data on orders, credit, sentiment, and employment often turn down months before headline GDP slows. When those gauges roll over while risk assets still rally, it usually marks a late stage of the cycle. It is the dashboard flashing orange, even while the engine still sounds smooth. In earlier crises, these indicators were already weakening well before funding markets snapped. The information was there, it was simply easier to ignore while prices were rising. Notice a third sign that often appears before a crash: a strange calm in credit pricing. Spreads, the extra yield investors demand to hold risky bonds instead of government debt, can remain very narrow, even as balance sheets become more fragile. In the years leading up to major crises, investors frequently underpriced default risk. The absence of stress in market prices became part of the story used to justify more leverage. This is one of the most dangerous illusions: the belief that quiet markets mean safe markets. The structure of the system has also changed in a way that makes pre-crash patterns even harder to spot. In earlier decades, most lending flowed through traditional banks, which were visible and heavily regulated. Today, a growing share of credit lives in so-called shadow banking: investment funds, money market vehicles, securitization conduits, and private credit funds. These players borrow and lend outside the usual rules but stay tightly connected to banks through derivatives, lines of credit, and shared exposures. Stress can now begin in what looks like a niche fund and then ricochet back into core institutions. The run does not need lines outside branches. It can happen electronically in hours. Follow the calendar and another pattern appears: the maturity wall. Every year, corporations and governments must refinance large chunks of debt that are coming due. When interest rates are low and risk appetite is high, this happens quietly. When rates have risen and lenders are nervous, these maturities become pressure points. If too much debt needs to be rolled in too short a window, weaker borrowers face a brutal choice between paying far higher costs or defaulting. Past crises in emerging markets have often erupted right as big maturity walls met changing global rates. Add policy constraints to this picture, and the final ingredients fall into place. POBA, governments that built up heavy debt loads face rising interest bills as old cheap bonds mature and new ones are issued at higher yields. Central banks, after long stretches of ultra-easy policy, must juggle inflation, growth, and financial stability at the same time. Cut rates too slowly, and economies stall. Cut too quickly, and speculative excess can return. That limited room to maneuver is a recurring feature at the edge of major crashes. Put all of this together, and the blueprint becomes clear. Before every major economic crash, credit expands faster than the underlying economy. Asset prices drift away from the cash flows that justify them. Leverage quietly piles up in banks and in the shadows. Funding structures rely more and more on short-term borrowing that assumes calm conditions. Early warning signals, yield curve inversions, weakening leading indicators, oddly tight credit spreads show up in the data. But the story of the boom is still so loud that most participants choose to ignore the signs. The crash itself always looks sudden. In reality, it is the final chapter of a long story. When the trigger arrives, a policy shock, a cluster of defaults, a geopolitical event, or simply a sharp change in sentiment, Investors rush for the exits at the same time. Prices fall. Highly leveraged players are forced to sell, which drives prices even lower. Funding markets seize up as lenders refuse to roll short-term debt. What started as a problem in one asset class spreads through the system. Credit to the real economy contracts, companies cut investment, and households pull back spending. A financial crisis becomes an economic crash. The lesson that repeats is simple. Crises hit hardest where leverage was highest, credit grew fastest, and oversight was weakest. Areas with more modest borrowing and stronger buffers still suffer in downturns, but they avoid full collapse. Economic crashes are not random meteor strikes. They are the logical endpoint of repeated decisions to add a little more risk because nothing bad happened last time. Memory is the only real defense at the system level. Institutions that take past crises seriously tend to build thicker capital cushions, stricter lending standards, and better resolution tools. Societies that study financial history are less susceptible to the seductive idea that this time is different. The names of the assets change. The human instincts driving the cycle do not. Yesterday's tulips, railroads, dot-coms, and subprime loans are today's fashionable trades and tomorrow's cautionary tales. In every era, the story feels new. The pattern is not. Before an economic crash, the same sequence plays on repeat. Credit booms, leverage climbs, warning lights flash, stories drown them out. Then some shock forces everyone to see what was already there. Scorecard. Net result 1. Major crashes follow credit booms supercharged by leverage. Net result 2. Yield curves, leading indicators, and credit spreads provide early warnings. When confidence breaks in an over-leveraged system, a downturn turns into a crash.